Paying down debt ruins the economy. Stop paying your debt down. Get into more debt and stop saving your money. If you pay off your debt, you are going to create more homeless people. You're going to create more jobless people, and you will literally F up the world, okay? What do I mean by that? I want to talk to you guys today about debt. I had a great question come to me on Instagram, really asking about debt and how it's created, and why it really makes the world go around. So I want to get into all of those details and more. So make sure you keep it locked. It's Crystal with the Cash Compass. All right, welcome back. I am here to teach you all the things that you should have learned in school about money, but for whatever reason, they forgot to mention it. If you love all things personal finance, investing, and economics, you'll definitely want to subscribe, and you'll definitely want to hit that bell because that's all we talk about on this channel. All right, let's get into it. All right, I want to jump straight into a whiteboard example of how debt kind of makes this economy go around. So let's just get straight into that. All right, so in our make-believe world, the only money that we are going to have, just to make everything simple, is this $10,000. Now, in actuality, I think something like 3% of the world's currency is created by governments. So not all the money is created by banks, but let's just assume, just to kind of really drive this point home, only $10,000 that we have in this economy, okay? So basically, this is you. You're real cute. And you said, listen, I need money because I want to buy a brand new car. So you go to the bank gives you this $10,000, okay? So now you are in $10,000 worth of debt. The bank did not have this $10,000. What they do is go into their computer and they create both sides of the entry. This is accounting. I don't want to get too complicated, but basically they're going to say, all right, we're going to just say this person had $10,000. We're going to write it in the system. We're going to type up $10,000 and we're going to give it to them as a loan, okay? So now the asset on the bank side is the $10,000 because you have to pay them back plus interest. Let's say this was like a 10% loan, okay? So, 10%. So we're not going to make monthly payments. We're going to just assume that at the end of the year, you're going to owe this $10,000 plus 10%. So that's $11,000, right? All right. So the bank created this money. This money did not exist in the world until you walked into the bank and said, I need $10,000. All they did was type it up on their screen and then they gave you this credit, okay? So a lot of the money is not actually printed. It's not actual real cash. It's all credit. So you go to your car dealership and say, hey, I want a new ride, right? I'm obviously not an artist, by the way. So you get your $10,000 and you give it to this car dealership, okay? So now the car dealership, the $10,000 has gone from the bank fake money to you. Now this is going into the real economy, okay? So we gave $10,000 into the real economy. Now this car dealership pays their customers, they pay their employees $5,000 each, okay? So now what we have is these two people have the $5,000 that you have borrowed into existence. So now they're going to go ahead and shop. I don't know what they're going to buy. They're going to buy some new shoes, some clothes, whatever they're going to end up spending, okay? At the end of the year, you need to come up with not only $10,000, but also the $1,000 because it was a 10% interest, okay? So you need to do whatever you need to do to make money. So whether you're working, whatever, eventually, let's say all else equal, there's no other money in this economy. There's only the $10,000. These people end up spending their money, right? Because most Americans don't save anyways. So they end up buying whatever they end up buying, food, groceries, and that $5,000 ends up coming back to you. Now, this is a separate situation, but if this was the only money in the world, we would have a big problem, right? Because there was only $10,000 loaned into existence, but they're asking you for $11,000 back. And if there wasn't any more money in this world, well, then you would be out of luck and you would be also out of a car because they would repo it because you didn't pay your full loan, right? So that's another problem in and of itself. Basically, more money needs to be borrowed into existence. So this person would also need to say, hey, bank, can I get a $2,000 loan, right? So then, or this person, let's just say, like, I don't think the screen is showing. So this person also has to go to the bank and say, hey, can I get a loan? And they're going to say, all right, here goes $2,000. So now you have $2,000 that's also into this world. And then somehow you up here need to come across one of those $2,000s, okay? So you can pay your bank back. So basically, once you pay your bank back, and I'm going to actually erase this so we can be a little bit clear. Okay, so once you, at the end of the year, you go ahead and you pay your bank back, that bank now takes this off of their ledger, right? Because remember, this whole thing was all created electronically. So you once had $10,000, but now you don't. That money has been paid off because you paid it back. You took it out of the economy. So now nobody has money, okay? Because it's all gone. All right, so I hope that was clear. Basically, we need debt. We are in a debt-based society. Back in the day, our money was limited by gold, right? So you could not create more money than you had gold, or at least a certain fraction of gold. So let's say for every $2 you create, you have to have 1 ounce of gold. That's not the exact calculation, but that's the exact idea. Now it's just kind of like, go crazy. Like if you want to, make that money print to go brrr, do that. And that obviously creates a problem because it's only based on debt. So somebody has to be in debt. It's not going to be me and you though, right? We're going to get out of debt. It's really important for money to not only be borrowed into existence, but also move through the economy. That is why I said paying off debt and saving is both bad, right? Because if you pay off debt, you're literally pulling that money out of the system. When you're saving the money, it's not necessarily getting pulled out of the system, but it is being tucked away. Maybe it'll come out later, and I'll explain why that's also a bad thing. But the point is, if you're saving, if you're paying off your debt, you're not letting money flow through the economy. You're not increasing the velocity of money. You're actually damaging it. And in order for an economy to thrive, money needs to be moving. Just as I said in my example, you took money from the bank. You paid the car dealership. The car dealership was able to pay their 2 employees. Those 2 employees were able to buy their groceries, buy their clothes, and that also puts money into pockets of other people working at other jobs, right? So we need money moving through the economy. That is why it's so important for you to stay in debt. If everybody pays off their debt, like in my example, that $10,000 is now gone from the economy. And if that was the only $10,000 in the world, there's no money to survive, right? No one's getting paid. Everybody's going to be very much so homeless, very much so without a job. And I want to show you guys this savings chart. And this kind of just shows what happened after we got that first stimulus check. So as you can see, the savings boomed, okay? Once people got that stimulus check, the money went straight up. That is not what they intended for the stimulus check. They wanted you to spend money, but the sentiment changed, right? And I'm going to get into the whole mind games and why they have to kind of play mind games with us. But basically, when people got the stimulus check, maybe they paid off their bills, right? But a lot of people who were still employed, who were still and were skeptical, they kept that money in their pocket, right? Because the mentality changed. We were in a pandemic. We have no clue what's going on. There's so much uncertainty. So instead of blowing that money like they probably normally would, because Americans happen to be big spenders, we just kept that money on the clench. So what they were trying to do, which is stimulate the economy, that didn't really happen the way they wanted it to happen, which is why sometimes you'll hear people on the TV saying we can't give the stimulus checks because they're not getting the results that they're looking for. So when you actually save money, it is not good. The government does not want you to do that because you are ruining the velocity of money. But what I find very interesting though is that is exactly what the higher ups do and those in charge, right? When they come across money, they hoard it. Look at Apple, who they have like billions of dollars. They have like billions of dollars just sitting there in cash, and they're not the only ones. Companies who are really well ran, they know to save their money because there's going to be opportunities in the future. And I'm going to have a whole different video explaining that. I don't want to kind of make this video entirely too long, but there's going to be opportunities where they can buy things for pennies on the dollar. So they definitely hoard their money and they look for certain investments that's going to put even more money into their pockets. You and I can't do that though, okay? We need to make sure we're spending so that when it does get to them, they can keep it. And that really increases the wealth gap, which I'm going to actually have a video coming up soon about the wealth gap. So you'll definitely want to make sure that you are subscribed so you can see that. But that definitely contributes to it, right? So you cannot save your money because, I am sorry. It is like a super, super sunny day. So I might have moments of like, it's sunny and it's cloudy. Another problem with getting stimulus checks is that a lot of people who are getting it are not working, or they have had less productivity, right? Maybe their hours got cut or something. So then you have a lot of people with extra money, but not a lot of people actually making more products, right? So what you'll end up having is this small pot of people producing goods and a whole bunch of people still able to buy those goods. That's also not good, because then that could drive up the prices of those goods. So that's why some people also say just giving money out freely doesn't really help the economy, because people need to work. So they're putting out and they're taking in. If everybody's just sitting around with $1 million, well, no one's going to want to work. Why would you want to work? So there's no productivity, there's no manufacturing, there's no services being performed, but everybody has money to spend. That will drive prices up. Okay, moving on. The same thing can actually also happen with savings, like I mentioned earlier. If your savings is just kind of sitting in your account because you are skeptical, because there's a lot of uncertainty going on and you don't really want to splurge, there will be a time where confidence is restored, right? People are starting to feel better and they can start making more purchases. So when that money starts coming out of savings, that can also create a hyperinflationary event. That literally has happened time and time again. We have enough history to show that. So not only do we need debt to keep the economy going, we need the debt to be dirt cheap, okay? We cannot have high interest rates. This is such a cocktail for disaster. It is unbelievable that unless people are not talking about this. But let me explain. We tend to pay a lot of attention to the stock market, which is important, but the debt market, that's where the real tea is, okay? And I'll have a whole video dedicated to explaining, equity versus debt market and what the significance is. But for right now, all you need to know is that the debt market is extremely bigger than the stock market, and it also has potential to really crush the economy, okay? What has been happening since 2008 is that our interest rates, for the most part, have been going down. They were kind of on an incline, but that was such a temporary period of time. The minute they started getting a little bit too high, the economy started to get a little shaky, baby. So we need interest rates to stay low. That means your mortgage needs to stay at 2%. That means corporations need to continue to be getting money to be getting money for dirt cheap, and these governments need to keep their treasury bonds at that 1% or maybe even lower. It's been creeping up lately, but I'm gonna have a dedicated video to just the bond market and talking about debt. But there are so many companies out here that are literally only alive because of debt. They do not make a single dollar. That is Uber, that is Lyft, that is Chewy. The last time I had checked, I haven't checked on them in a while. But the point is, they're not alone. There are many companies who absolutely need to be borrowing money just to stay afloat because their business model sucks and they don't make enough money to actually pay people without going into debt, right? And a lot of times with these corporations, their debt is actually variable rate, okay? So for the most part, on a personal level, we might go get a car. It'll be a flat rate. You might get a house, for the most part, will be a fixed rate. A lot of corporations' debt is variable rate, okay? It'll be like LIBOR plus something. So what happens when the interest rate starts creeping on up? What once was maybe $100 of debt you had to pay back now turns into $200 because the interest rate has gone up. And if you think about that on a personal level, let's say you had a credit card debt, right? And your credit card bill was always $200 every single month. But then next thing you know, you get news that next month it's going to actually be $400 a month. Well, what are you going to do? Right? Something has to give. You might have to spend less money eating out. You might have to, not give your kids allowance. You might have to take on another job, but you're going to need to take some sort of action to actually pay that. So imagine that, but times corporations, okay? What does that equal? Massive layoffs, right? Because if I have to spend more money to service this debt, well, now I can't really afford to pay you that money because I owe them. And if I don't pay my debtors back, they can start taking my assets, right? Because a lot of times the debt is secured by something. So you have to think, do I want this one employee who probably don't even know their name, right? And I could just make another employee work twice as hard. Do I want to keep this one employee, or do I want to keep my wherever I rented, right? Like maybe if I bought a piece of property and the person who loaned me the money is going to take the property if I don't give them the loan back, right? Like, so who do I pick? Obviously, the employee can go goodbye. Oof, I am so sorry, you guys. But yeah, we can go ahead and get rid of that employee because we want to keep our building, okay? And if that happens across the globe, or at least across America, that can create an extreme catastrophe and it can really shake through the whole world. So you might think, okay, well, I'm fine. My job is secure. But you don't necessarily know that because you don't know what these people's jobs are going to be impacting. So obviously, if people are getting laid off more, that'll also change the sentiment. People will be spending less. People will be paying off their debt. All things which are horrible for the economy because the economy is debt-based. So what do? They have to play mind games with you, okay? It's kind of like that person in your life who always apologizes. They're always so sorry for what they did, but they never actually take action. Right? They never actually fix their problems. They don't actually improve. They just throw a whole bunch of words at you. For a while, it's going to, it's going to work. You're going to believe it. Yeah, this time is different. Like, they're going to be better. But then eventually you get sick of it, right? And you're like, all right, this person is not changing. You got to go, right? It's the same thing that works on the government's level, okay? Do they want to just start pouring out a whole bunch of stimulus money like right now? Not really. It's much easier to kind of string you along, give you the impression that they're working so hard, they're fighting, they're talking about it, they have a whole bunch of proposals, and you get excited about the thought of it. And then they drag their feet, and then 8 months later, okay, let's give you even less than what we actually promised, right? That's exactly what happened. After that first stimulus check, there was a lot of talk about another stimulus check that was going to be $2,000, or it was going to be, at least another $1,200, and then ended up being only $600. It was half that, right? But it was the mind game. They're just telling you, listen, don't worry. Like, we will come up with this check. It will happen. And that might change your sentiment. You might have more faith in the government. You might have more faith in the economy. You might spend more freely because you know that, okay, this money is coming up eventually. So let me just kind of, spend the money now. Eventually I'll get it back. They change the mindset of people. Same thing when it comes to the housing market, right? And this one, they actually took more action, but still they tell us, okay, don't worry. We're going to be buying mortgage-backed securities for the next foreseeable future, okay? So what does that mean from a banking level? Well, as a bank, I can go ahead and originate all these loans and give people loans, whether or not, they really qualify all that well, because what I'm going to do is end up just taking that loan and selling it to the Federal Reserve, okay? So that definitely gives banks more confidence to loan more money out. That gives people more confidence to actually get those loans, right? And to go into debt, which is what we want, right? At least when I say we, I'm not talking about me, but that's what the government wants. They want people to get into more debt. When you feel more confident and they're lending more money out to you, that'll keep the housing market propped up. And when people have the housing market propped up, they feel good because you see your house, your equity is increasing, you feel rich, you feel good. If that market starts to contract, people will have a less perceived sense of wealth, okay? Because now it's like, well, I thought I had $100,000 worth of equity in my home, but now I only have $50,000. So I'm start moving differently, right? But they don't want that. So they have to keep on telling you, don't worry, we have your back. With the corporations, same exact thing. These corporations, a lot of them suck and they do not deserve any extra money because their business model is not a viable business, right? But the Federal Reserve has come in and said, listen, don't worry. If they fail, we will buy up the debt for them. You can go ahead and invest in these junk corporations. You can give them money because if they do not pay you back, we will just buy that bond from you, okay? They haven't actually done a lot of that, but just planting that seed in people's minds has people investing much more into these corporate bonds, especially because when it's a really bad company and they don't really make all that much money, well, then you're going to demand a higher, you have to give them a higher interest rate, obviously, because they're a little bit more riskier. So people are chasing these risky investments because they feel like, okay, well, worst case, I'll just fall back on the Federal Reserve buying up this corporate debt and I get my money back, okay? So it's a bunch of mind games. They're just telling you, yeah, I got you. Like, don't worry. And that'll work for a long time because they don't have to actually do anything. That thought alone encourages people to take risks. It encourages people to get into debt. And when the con game is over and people are no longer confident, that's when things come crumbling down. All right, that was a mouthful. I hope that kind of explained a little bit better why debt is super important and why it's so crucial for people to continuously be in debt, because once you start pulling money out of the system, it'll crash the whole system. Now, of course, I don't necessarily think that we should be in debt. Like you and me, we're going to be debt free, okay? That's someone else's problem. You guys help the economy. I don't want to, we have no parts in that, right? We want to save up and we want to have investments that pay us. We want to have good debt that actually, puts money in our pockets and then takes care of the debt as well. But they want you in that debt that's going to really screw you, okay? But we don't want no parts of that. But let me know what you guys think. Did I make it clear? Did I miss anything? Let me know in the comments because I want to hear from you. But that will do it. If you like this video, then please be sure to like this video and share it with your friends so they can know the difference between good debt and bad debt and why debt is extremely important, all right? And if you have anything else going on, you know what to do. Go ahead and binge watch me. And until next time, keep your money up.